Silver just smashed through $80. And this is not just another rally. This is not a random spike. This is not retail hype. Something far bigger is unfolding behind the scenes. A silent squeeze, a supply shock, a geopolitical chess match playing out in real time. Physical silver is disappearing from vaults. Buyers are paying massive premiums. Major institutions are quietly repositioning. And while most people think this is just another bounce after a crash, the truth is far more explosive. What if $80 isn't the top? What if it's the launch pad? Today, I am breaking down what's really happening and why this move could redefine the silver market. On the surface, silver's move above $80 looks like just another volatile swing. After all, this market recently surged to extreme highs, then crashed nearly 50%. Many investors were shaken out. Confidence cracked. Headlines declared the bull market dead. But that surface-level interpretation misses the deeper issue. The real problem is not price volatility. The real problem is structural fragility in the global silver market. For years, silver traded under $30. Industrial giants built entire supply chains assuming it would remain cheap and abundant. Solar manufacturers, electronics producers, and refiners scaled operations around predictable, low-cost inputs. Investors accumulated casually. Banks treated silver as a manageable commodity. Easy to source, easy to hedge. Then the deficit cycle began. For multiple consecutive years, global demand quietly exceeded new mine supply. Above-ground inventories shrank. Vault stocks declined. Lease rates began fluctuating. But because paper markets dominate price discovery, the stress remained hidden. When silver rocketed higher, many assumed it was speculation. But underneath, something else was breaking. Access. Industrial users suddenly faced tighter supply. Physical premiums widened, delivery timelines extended, refiners became backlogged, dealers imposed minimum orders. Some mints temporarily halted new requests. And then came the crash. From the outside, it looked like the bubble popped. But what if the crash wasn't about excess supply? What if it was about relieving pressure in a system stretched too thin? Here's the core problem. The paper silver market is many multiples larger than the physical metal available for delivery. Contracts can be created instantly, but ounces cannot. When physical demand accelerates while available inventory shrinks, the pricing mechanism becomes unstable. The divergence between screen price and real-world acquisition cost grows. Premiums expand. Arbitrage becomes difficult. Trust erodes. Now silver is back above $80, but the underlying supply imbalance has not been resolved. If anything, it has intensified. The market is walking a tightrope, balancing leveraged paper positions against limited physical inventory. And when that balance shifts, price moves can become violent. That is the real problem. Not volatility, not speculation, structural strain. But here's where the story turns. Because what happened over the past 6 months wasn't random. It wasn't chaotic. It followed a pattern, one that most investors never saw. Large quantities of silver quietly moved off major exchanges. Registered inventory declined. Eligible inventory rose. That means metal remained in vaults, but was no longer available for delivery claims. At the same time, physical demand exploded in key global hubs. Dealers reported record sales volumes at elevated prices, not during dips, but near highs. That detail matters. Buying strength at high prices signals conviction, not bargain hunting. Miners began reporting realized prices significantly above benchmark exchange averages. That suggests negotiated premiums. Real buyers paying more than the headline price to secure supply. Meanwhile, Asian markets showed widening spreads over Western spot pricing. In certain periods, regional premiums surged dramatically, reflecting localized tightness. Add to this the behavior of institutional players. Some major financial entities appeared to shift positioning, moving from persistent short exposure toward more neutral or even net long configurations. Then something else occurred. Volatility spiked, margin pressures rose, and a significant market correction followed. Was it organic, or was it a pressure release valve? When silver plunged, leveraged participants were forced out. Speculative excess was cleared. But physical demand did not collapse. In fact, it stabilized quickly. Within weeks, price found footing. Then it climbed again. That recovery speed is unusual. In previous cycles, such as the early 1980s or 2011, post-crash recoveries took years. This time, stabilization occurred within weeks. Why? Because the correction addressed leverage, not supply. And here's the bigger tease. If structural demand remains intact, and if above-ground inventory continues tightening, then $80 may not be resistance. It may be reaccumulation. The next key level sits slightly higher. If those break, price discovery could accelerate rapidly due to thin historical trading volume in that range. But before jumping to targets, we need to understand the deeper story, how global supply chains, institutional positioning, and geopolitical dynamics converged into this moment. To truly understand why silver breaking above $80 matters, we need to rewind and examine how we got here. Because this move didn't begin last week. It didn't even begin this year. The foundation for this moment was laid years ago, quietly, gradually, and largely ignored. For most of the past decade, silver was considered the forgotten metal. While gold captured headlines as a safe haven asset, silver drifted sideways. Investors lost interest. Institutional allocations remained small. Many analysts labeled it too volatile or too industrial to deserve serious, long-term attention. But beneath that boredom, something critical was happening. Global demand for silver was shifting structurally. The rise of renewable energy, especially solar power, dramatically increased silver usage in photovoltaic cells. Every solar panel requires silver paste for conductivity. As governments pushed aggressive decarbonization targets, solar installations surged. That demand wasn't speculative. It was policy-driven and capital-backed. At the same time, electronics consumption remained strong. Smartphones, medical devices, electric vehicles, semiconductors all require silver for its unmatched conductivity and antimicrobial properties. Unlike some metals, silver cannot easily be substituted without sacrificing efficiency. Meanwhile, mine supply growth stagnated. Unlike gold, most silver is produced as a byproduct of mining for other metals like copper, zinc, and lead. That means silver production doesn't ramp up simply because silver prices rise. It depends on base metal mining economics. If copper production slows, silver supply often slows with it. This created a subtle but persistent imbalance. For several consecutive years, global silver demand exceeded newly mined supply. The difference was covered by drawing down above-ground inventories, exchange vaults, private holdings, and stored reserves. For a while, the system absorbed that imbalance quietly. But inventories are finite. As stockpiles declined, early warning signals began appearing. Lease rates, which represent the cost of borrowing silver, started rising intermittently. Delivery wait times lengthened. Dealers in various regions began reporting periodic shortages of popular products. Premiums above the quoted spot price widened during periods of stress. Most market participants ignored these signals because the futures market, particularly contracts traded on exchanges, continued to dictate the headline price. And in the futures market, liquidity was deep and leverage was abundant. Then momentum arrived. Silver climbed from $30 to $40. Analysts called it a catch-up move relative to gold. Then it moved from $40 to $50. More investors began paying attention. Media coverage expanded. Trading volumes surged. And then the rally accelerated. When price action becomes vertical, psychology changes. Fear of missing out replaces caution. Leverage increases. Traders pile in not because of fundamentals, but because of speed. The surge toward triple digits happened fast, faster than most structural supply adjustments could justify. That kind of move invites instability. High volatility stresses leveraged positions. Exchanges raise margin requirements. Funding costs increase. Any negative catalyst, macro uncertainty, liquidity tightening, or profit taking, can trigger cascading sell orders. That's exactly what happened. The correction was violent. Nearly half the value evaporated in a compressed time frame. Headlines declared the bull market finished. Sentiment flipped from euphoria to despair almost overnight. But here's the critical difference between this cycle and historical collapses like 1980 or 2011. In 1980, the spike was driven largely by concentrated speculative activity and rule changes that abruptly altered market mechanics. Once leverage was removed, demand evaporated. In 2011, exchange-traded fund inflows fueled the rally, but structural industrial deficits were not deeply entrenched. When investor appetite cooled, price retreated and remained suppressed for years. This time, the crash removed leverage, not demand. Industrial consumption did not disappear during the correction. Solar installations did not halt. Electronics manufacturing did not reverse. Long-term infrastructure projects did not get canceled. If anything, the broader global push toward electrification and energy transition continued strengthening. During the correction, speculative participants were forced out, but physical buying in multiple regions remained resilient. Dealers reported steady interest even at elevated prices. Some producers continued reporting realized sales prices near structural support zones, suggesting longer-term contract stability. Then, something notable occurred. Silver stabilized far faster than in previous cycles. Instead of grinding lower for months or years, price found footing near the $70 region. That level aligned closely with reported production economics and negotiated supply agreements. It appeared to represent a new equilibrium between industrial buyers and producers. From there, silver began rebuilding. Higher lows formed, volatility compressed. Momentum indicators reset from extreme overbought conditions to neutral territory. The market digested excess. And now, silver has reclaimed $80. Technically, that level matters. It represents prior breakdown territory. an area where sellers previously overwhelmed buyers. Reclaiming such a level suggests strength. Holding it would suggest even greater strength. But technical structure alone is not enough. It must be supported by fundamentals. The fundamentals today include multi-year supply deficits, strategic mineral reclassification in several jurisdictions, rising geopolitical resource awareness, and industrial demand tied to long-term macro trends. In addition, institutional behavior appears more strategic than speculative. Streaming and royalty companies have entered multi-billion-dollar agreements that effectively assume sustained pricing above historical averages. That capital allocation reflects conviction, not short-term trading. At the same time, exchange inventory data continues to show sensitivity. Movements between registered and eligible categories indicate positioning shifts. Delivery volumes during key contract months remain closely watched by professionals. The broader macro environment also plays a role. Currency fluctuations, inflation expectations, central bank policies, and geopolitical tensions all influence precious metal sentiment. But unlike previous cycles, silver today is not just a monetary hedge. It is deeply embedded in industrial transformation. That makes this story different. The explosive rally may have come too far, too fast. The correction may have been necessary, but the structural drivers that initiated the move remain intact. If supply growth continues lagging industrial demand, equilibrium pricing may trend higher over time. Not in a straight line, not without volatility, but with persistence. The move above $80, therefore, is not just about momentum. It is about whether the market has reset and is preparing for another structural advance. The coming months will determine whether this breakout holds. Sustained closes, stable demand metrics, and continued tightness in physical markets would reinforce the bullish structure. Failure to hold could extend consolidation. But one thing is clear. The silver market today is more strategically important, more industrially embedded, and more structurally constrained than it was in prior decades. And that context is what makes this moment significant. So what does silver above $80 really mean? It means the market just crossed a line that separates recovery from potential expansion. After crashing nearly 50%, most assets take months, sometimes years, to rebuild confidence. Silver did it in weeks. That alone tells you something important. The correction flushed out leverage, but it did not destroy underlying demand. Industrial buyers did not disappear. Long-term contracts were not canceled. Structural deficits did not suddenly reverse. Instead, price stabilized around the $70 zone, a level that appears to align closely with producer economics and negotiated supply agreements. That stabilization matters. Markets don't base at random numbers. They base where buyers and sellers agree value exists. Now silver has pushed above $80 again. Technically, this level was major resistance. It marked a previous breakdown point during the sharp sell-off. When price reclaims a former breakdown level, it signals regained strength. But reclaiming is only step one. Holding is step two. If silver can close above $80 consistently, not just spike intraday, it suggests that what was once resistance has turned into support. That shift changes psychology. Traders who previously sold at $80 may now buy pullbacks toward it. Momentum systems re-engage. Trend models flip bullish again. But technicals alone don't justify a sustained move. Fundamentals must confirm it. And here's where things get interesting. The multi-year supply deficit hasn't been solved. Mine production hasn't surged dramatically higher. Silver's industrial demand drivers, solar expansion, electrification, electronics growth, remain firmly in place. Governments across the world continue pushing infrastructure and energy transition spending. Meanwhile, inventory sensitivity remains visible. Exchange stock movements are closely monitored because available supply isn't abundant. When a market trades on tight inventories, price reactions can be exaggerated. Another key factor is how quickly silver rebounded from its low. In prior historical collapses, like the early 1980s or the post-2011 decline, recovery was slow and grinding. This time, stabilization was rapid. That suggests underlying buyers were waiting. It suggests structural interest, not just speculative enthusiasm. There's also the capital allocation signal. Sophisticated players in the mining and streaming space have committed billions in long-term silver-linked agreements. Those deals effectively assume silver pricing above historical averages for years, not months. Institutions don't deploy that scale of capital without deep modeling and conviction. Now let's talk about what happens next. The next resistance zone above $80 sits modestly higher. If silver breaks and sustains above that band, there's relatively thin historical trading volume before previous highs. That means price discovery could accelerate if momentum builds. However, failure to hold above $80 would likely extend consolidation. That wouldn't automatically invalidate the structural story, but it would delay expansion. So the confirmation checklist becomes critical. Sustained closes above 80, stable or declining visible inventories, continued strong industrial demand data, no sudden surge in mine supply, physical premiums remaining firm. If these conditions remain intact, the probability of a renewed leg higher increases. This doesn't guarantee immediate triple-digit prices. Markets rarely move in straight lines. Pullbacks, retests, and volatility are normal, even healthy, within bull cycles. But structurally, silver today is positioned differently than in past speculative peaks. It sits at the intersection of industrial transformation, monetary uncertainty, and resource strategy. That combination is powerful. And that's why this move above $80 isn't just another bounce. It may be the signal that the next phase has begun. Now I want to hear from you. Are you viewing $80 as resistance or as confirmation? Did you hold through the correction, or are you waiting for clearer signals before positioning? Do you believe industrial demand will continue tightening supply over the next several years? Or do you think new mine production and recycling will rebalance the market? Drop your perspective below. Healthy markets thrive on debate. Some will argue that volatility signals instability. Others will argue that volatility signals opportunity. Both views deserve consideration. If you found this breakdown helpful, share it with someone who follows metals but hasn't looked deeper into the structural side of the story. And if you're tracking specific indicators, lease rates, inventory data, miner earnings, mention what you're watching. The more eyes on real data, the better decisions we all make. We started with one question. Is $80 the ceiling or the launch pad? Now you've seen the bigger picture. A market that corrected leverage but not demand, a commodity facing multi-year deficits, industrial consumption tied to long-term global transitions, strategic interest rising, inventories tightening. The breakout above $80 is not the final chapter, it's a checkpoint. The next resistance zone will test conviction. If price holds above it, momentum could build quickly. If it fails, consolidation may extend, but the structural narrative remains intact unless supply meaningfully expands or demand collapses. Watch the data, not the noise. Because silver's story isn't just about charts. It's about who controls resources in a changing world. And this cycle may still be in its early innings. Stay informed, stay analytical, and watch what happens next.